Welcome to 5 years of no BS option selling advice. In this video, I'm going to hold nothing back. I'm going to show you what happened and why I blew up 2 accounts and now how I'm able to make $5,000 to $10,000 every single month by selling options. But not only have I done it for myself, I've helped over 600 option traders do the same thing. I've helped them generate over $600,000 and verified profits from their broker. And now I want to help you do the same. So here's the plan for this video and what you're going to learn. You're going to learn what an option is. I'm going to simplify it down so even if you're new, you'll understand it. I'm going to show you why option selling is super profitable and it beats YOLO trading. I'm going to show you the 3 best option selling strategies, some of the ones that I'm using today to make my $5,000 to $10,000 a month, and also ones that work well in different markets. I'm going to show you how to mitigate options trading risk so you can be aware what risk is there with option selling and how do we get rid of it or at least minimize it. And I'm going to show you how I personally make $5,000 or more every single month. It's going to be a case study over what I do for my account. And again, you can see here on my Tasty Trade account, on this live account, let me refresh here real fast. So you can see already today, I've made roughly $755, around $700 from option selling. So let's dive into it. Let's start with number 1. What is an option simplified? So I'm not going to hold anything back. Let me make my face smaller so we can see more screen and get this party started. So if I'm going into here, we're basically just going to look at what exactly an option is. And so again, there's 2 different types of options. There's a call option and there's a put option. Now, these options are just like sports betting. So if you know anything about sports betting, you're just saying, hey, I bet this player will throw this far. I bet this player will run this many yards, something like that. We're doing the same thing, but on stocks. We're betting on what a stock will do. Hey, I bet a stock will get up to this level, or hey, I bet a stock will stay above this level. Whatever it is, a option is essentially betting on a stock or whatever the underlying is, okay? And so there's 2 different ways to bet on something. Calls, when you buy a call, you make money when the stock goes up. So you're betting that the stock goes higher. If you buy a put, you're betting the stock goes lower. So again, when you buy a contract, that's what it does. I'm going to put a plus here to represent we're buying it. Now, when we sell a call, it's going to do the opposite. So we're actually going to make money when the stock drops. So if we sell a call, we're going to make money as the stock drops. If we sell a put, we're going to make money as the market goes up. So there's 4 ways to make money in the option space. We buy a call, it goes up. We sell a call, we make money when it goes down. We buy a put, we make money when it goes down. Or if we sell a put, it makes money when it goes up. Now, again, what we're going to be focusing on here is option selling. So this right here, so when I refer to selling a call, I mean making money to the downside. And when I say selling a put, it means making money to the upside. So what exactly does this look like here? Okay, so let's pretend like this is a stock, okay? So this is where the stock's trading right now. And I say I want to sell a put at this level. What does this mean? This means I am betting that the stock will stay above this level, right? Because selling a put is up. So I'm betting the stock will stay above this. Why is this great? Because it means I'll make money if the stock goes up. I'll make money if the stock goes sideways. And I'll make money if the stock goes down, as long as it doesn't go below my level. The only time I lose money is if it starts breaking this level at the expiration date, okay? So this is what we're looking at as option sellers. This is why it's way more profitable. So let's already jump into the next step here, which is part 2. So let me remove this. Part 2 of this video is why option selling is super profitable. So as we mentioned before here, there's so many ways to win as an option seller, right? If I think the market's going to go up. So let's say this market, is staying in a nice little uptrend and it's right here. And I think the market is going to continue up. If I buy a stock, it's a 50-50 chance. Either the market goes up and I make money or it goes down and I lose money. So a stock has a 50-50 chance of making money. So again, I don't really like those odds. I want to put more odds in my favor. So when I do an option, I can be like, okay, I think it's going to go up, but I'm going to go way down here, maybe 10 to 20% below where the stock is trading to give me a nice room of margin. As if it goes up, I make money. If it goes sideways, I make money. If it goes down, I make money. The only time it goes down super far. So again, let's just say that each of these are the same odds, right? If we have four different outcomes here and 3 makes us money, then in theory, depending on how we're trading, if we sell options, we're going to have a 75% chance of winning versus a 25% chance of losing. And so this is why option selling is amazing, because now we can do this. Not only that, it's super consistent. Like I mentioned, we can have as much as a 75 to 95% win rate on these trades, which is what I'm seeing. And so after that, it all comes down to, okay, now that we have the super high win rate, how do we collect enough money and decrease our losses in a way that makes this win, right? Because if we're able to do this, let's say we have a 75% win rate on this, and we win $1,000 per trade, But when we lose, say, $100 per trade. Well, this is going to win, right? Why? Because we have $75,000 as our profit, and then we end up losing $2,500. Well, now we made a net profit of trades. That's amazing. And so this is all we're doing as an option seller. We're looking at what's the win rate, how much can I win per trade, and how much can I lose per trade. So if you're someone who likes statistics and likes math, this is for you, and this is essentially all we do. Win rate, and plus how much money we'll make when we win and how much money we'll lose when we lose. And again, obviously the win rate's higher because it can do anything. We'll still make money. Again, these were both put selling examples. If we want to show a selling call example, we'll say it's something like this. We can see more of it's in a downtrend. And so call, we're betting the stock stays below this level. And so as long as if the stock goes down, we make money. If the stock goes sideways, we make money. And the stock goes up, we make money as long as it doesn't break this top level. And so that is what this is. So that is what options are and options selling. And now let's go into the next section is what are the 3 best options selling strategies? Okay, so very simple. There's a lot of different ways that we can combine this. Obviously, we could just sell a put and bet the stock goes higher. We could sell a call, bet the stock goes lower. But there's some ways to combine all these things together to give us a higher win rate and to reduce our risk. Like I mentioned before, if we can have a high win rate, if we can have a high win rate and we can reduce our risk, then we're going to have a huge net profit on the downside. So let's walk through this. Let's go through strategy number 1, which is the simplest strategy, and that is selling a put. So as mentioned before, we can bet the stock goes higher. Now, why would we want to do this? Well, it's because we're betting on the S&P 500. The S&P 500 in general goes higher. So like literally 90% of the years that the S&P 500 has been trading, it's been a positive or neutral month. And so if it's a sideways or positive month or year or whatever, that's how we crush it with this. So selling puts works best in bullish markets as well as sideways markets. So you can deal with my handwriting here. It looks bad on this. So bullish and sideways markets is what this works best on. And so that's what we're seeing here. And so again, typically when we're selling puts, again, I'll show you how to do this on the broker here in a second, but we're doing a 10 delta, which means that we're giving ourselves a lot of downside move. And then we're going to manage it with roughly a 25% take profit. And then from here, we're also going to use a 300% stop loss. And so this is what this looks like on the broker. So if I go into the broker here and pull this up for myself, go here to a trade tab. Let's see, I like doing futures options, but again, this works the same way on SPY. So I'll just pull up on SPY here for this example. So we're going to sell a put. I forgot to mention here one more thing. We're looking to go further out. The further out we go, the less our risk. And by that, I mean each contract has a date at which it expires. And that expiration date, the further out we put that in the future, the more money we'll make and the less risk we'll have. And so what I like to target is between 90 to 120 DTEs for my expirations. This tends to give the most consistent, most stable returns. So if I'm looking at that, I'm looking at the strikes here. They all have a day associated. As you can see, 92 days, 108, 122. So again, in here is what I'll kind of look for. I'll do the 108 here for this example since it's in the middle of what I'm looking at. Now, like I mentioned, we look at delta. So make sure your broker is showing delta as one of the drop-down options. You can see here, mine's already showing delta. And I'm going to look for a 10 delta. So it's minus 10 actually, but 10 delta here. So what I'm going to do is I'm going to sell this contract. And so again, if I click on this, let me refresh my page here, give it a sec. I'm going to be going for the 10 delta. Why? Because that pushes my risk away a lot. And I'll show you exactly what I mean by that here in a second. So I go to the 10 delta mark. We're going to sell right here. So right here, we're going to sell. So this is a $515. This is where I'm betting on that level. Remember I said an options contract is just betting on a certain level. $515 right here is the price point. Well, the market's currently trading at $600. That means the market needs to drop about $85 in order for me to actually lose money by expiration. And that's what's amazing about this. Okay, we'll talk more about risk management later, but this gives me a huge win rate. You can see right here, my probability of profit, my chance of winning and making money on this trade, 96%. So now I have a 96% win rate. So let's mark that down so you can kind of see the numbers for each strategy, okay? So I'm looking at a 96% win rate, and then let's look at this. So if I'm looking at my max profit, I have about a $360 max profit. So if I do 360 times a 25% profit, that's going to give me a $90 profit. So I'm going to have a $90 profit when I take profit, the 25% take profit. And then my stop loss, if managed correctly, you can see here, $51,000 of max loss. And so again, that's a lot of loss. But again, we prevent that by just doing what did I say? It was a 300% stop loss, 200 to 300%, quite normal. So you can manage risk however you want if you want less risk. But for this example, we'll do the 300. So again, if we're trading at 362 as our max profit, we're going to multiply this by 3, and that's going to give us roughly $1,000 as our loss. So minus $1,000. And so now we can see what the outcome of this trade is. Again, if we put it in here, we can do the math. Again, I'm just going to do the math on my quick little calculator. So I'm going to do 96 times 90 as my profit, and I'm going to subtract 4 times 1,000. And just like that, you can see here how we have a net return of plus $4,640 is what I got. So just like that, you can see if we trade this long term, if we stick with the strategy, we're going to have a positive outcome. And so that's why, hey, now that I know this works, I can just continuously trade it. Now, obviously, you can increase your win rate and do better if you stick to bullish and sideways markets. If you're in a bearish market, you probably don't want to do this strategy. So that is strategy number 1. Now, strategy number 2, we'll pick up on that right here. Strategy number 2 is going to be a strangle. And so what is a strangle? A strangle is combining both selling puts and selling calls. So if we have a stock right here and it looks like it's going more neutral or slowly going up, then what we can do is we can sell a call, which is betting the stock stays below it, and we can sell a put, betting the stock will stay above it. This means as long as the stock stays between these two levels, we'll make money. If it slightly goes up, we'll make money. If it stays neutral, we'll make money. If it goes down slightly, we'll make money. And so again, strangles are best in sideways markets. And as I'll show you here in a bit, I skew it to the upside. So sideways plus slow bullish markets. And that's kind of how we trade these right here. And so this follows the same approach. Again, we're doing roughly 90 to 120 days out because this gives us the most consistent structure on the trade, the highest profit and the lowest risk. And then again, we can also do, again, I personally do a 25% take profit on this trade as well. And then I do a 300% stop loss as well. It's the same thing as the short put, but now we're adding another side to the top. Now, how I pick these strike prices are a bit different. Why? Because the overall market, the S&P 500, tends to drift higher, tends to move up. And so since that's the case, I want to give myself more room to the upside and less room to the downside, because more times than not, we'll move higher. And I don't want to break my upper level that I'm betting on. I want to push that higher to give me a higher win rate. And so what I do with that is I do a 10 delta for the put, so 10 delta put, and I do a 5 delta for the call to give me more upside room. And this way I can skew it to the upside so that as the market continuously drifts higher, which it's known to do, it's accounted for. So if I clear out this trade, what does that look like? Again, we're still in the 122 DTE type of level, which is what we're looking at. Again, we're going to sell the 10 delta put. Then we're going to go down to the call side, which is on this side, and we're going to look for 5 delta. So we see here 5 delta, perfect. Now, what do we do here? Well, you can see here our max profit now increases and our percentage win rate decreases as well, because like I said, we capped one of our sides. So they cap one of the sides. Now, if the market shoots up, that call will get hit. So our win rate does go down slightly. So we can look at that. Now we have an 84% win rate on this, but now we're collecting credit times 2, basically. So instead of collecting $90 of credit, we're able to collect 440. And if we do 440 times 0.25, that's going to give us $110 of profit. So now we increase our profit by 110. But with that, we also increase our loss. Again, our loss is going to be this amount, 440 times 3. So 440 times 3 is going to be roughly 1,300. So if I go here, minus 1,300. And so we can see how this plays out. So again, we can do the math on that. Give me a quick sec. The math will be 84 times 110 minus 16, because it's going to be 100 minus 84 for the loss rate, times 1,300. So again, this leads to a net loss like this, minus 1,300 is kind of how this goes. And so this ends up losing us money long term, and that's because this win rate is dramatically impacted. And so that's something that I wanted to show is you always want to make sure that your numbers work out before you do them. And so these are the numbers for a strangle, and that's kind of how it's run. And I may be like, Austin, why do you run this strategy? Well, this is what I want to show you. when you put stop losses on positions, it helps cap your losses, but it's really going to dramatically impact your win rate. And so again, if you do back tests, which I'll show you here in a little bit, if you remove the 300% exit and you replace it with closing early at 21 days, this is going to bump up your win rate to 90. I believe it's 95%. We'll pull up the back test here in a sec, but it's a 95%. So now we go back here, we have a $110 profit minus $1,300. And if we redo the math, what we get here is we bump up the win rate to 95 and we decrease the loss rate to 5%. And that gives us a $3,950 profit. So this now turns into a winning trade. So what do we learn from here? Number one, if we're trading a strategy, make sure to trade it in the market that it works best for, sideways and slow bullish markets. If you trade it outside of the ideal market, then you're going to have a lower win rate. Also, having a stop loss is a great idea to cap losses, but it's also going to get you out of a trade too early. You're not going to let the trade play out. And so things like strangles, where the win rates are a bit lower, you ideally want to let that trade play out instead of trying to close it early. And so another way to do it is getting rid of a 300% exit and closing at 21 DTE. And the loss amount is roughly the same, but now you give the trade more time to execute, turning it into a winning trade. So we have a sell put strategy, we have the strangle strategy, and last but not least, for smaller accounts, because it does take a good amount of money to put on this trade. You can see here it takes about $6,000 to put on this trade. For a smaller trade, we have a put credit spread. So we do here put credit spread. It's going to be the same thing as selling a put. It's the same type of direction, but we're going to sell an option and we're going to buy an option. So again, it looks like this. We're still betting that the stock goes higher and stays above this level, but now we sold and we bought a put. And so this still gives us money. So that's what a put credit spread is. This works best for, just like selling puts, a bullish strategy and bullish market. Now, what are some things to keep in mind when we're trading these strategies, okay? If we increase our win rate, we will decrease the amount of money we're making. So we'll decrease our profit. Why is this? Well, because the market is kind of efficient, and so it knows how it works. It's not just going to give you a higher win rate for the same amount of profit. So if you increase your win rate on a strategy, you're also going to decrease your profit. And so that's why you have to juggle your win rate and your profit and loss ratios. And as long as you have them correct, then you'll be able to do well with it. Now, what if we increase, or I should say decrease our take profit, okay? If we decrease our take profit ratio, how much profit we're taking. So for instance, here we, in both of these, we take a 25% take profit. If we decrease that, so let's say we go to 10%, we'll increase our win rate, okay? So again, this is the same thing, but opposite, right? So this means that we increase the take profit to maybe 50%, we'll also decrease our win rate. So the take profit percentage is directly related to your win rate. And so again, you can back test it to see those differences, but that's kind of how that works. The same thing with the stop loss. If you increase your stop loss, you will increase your win rate. So these are directly proportional compared to these, which are inversely related. And the reason for that is because as you increase your stop loss, you're giving yourself more time in the trade, and more time in the trade is allowing you to actually let that trade play out, and letting that trade play out then gives you more time to be right, which allows your win rate to be higher. So if you decrease your take profit because you want to lower your risk, you're also going to decrease your win rate as well because you give yourself less time in the trade. So you have to juggle it. So that's why typically you go as high as a 300% stop loss to allow yourself plenty of time, or you just close the trade at 21 DTE and manage your risk by the amount of buying power you have in the trade. So that's kind of how you do it. You manage risk by how much money you have in that trade instead. And so now you may be wondering, well, how much buying power should I use? Well, this is when we start getting into the next part of this video, which is how to mitigate options trading risk. And so there's some risk here that we're looking at. And those risks when it comes to option selling is like this. Let's pull it up right here. This risk is number one, market risk, okay? So we have market risk. What is this? Like I mentioned, these strategies perform well in different types of markets. Obviously, we can do a call credit spread as well. This is something I'm throwing at you last minute, sorry. If we want to make money in bearish markets, it does the opposite. So Again, there's different strategies for different types of markets. And so if we're trading in the right market, we're going to do really well. But if we don't, if we trade in the markets that's not good for us, we're going to have a lot of risk and we're probably going to lose most of the time. So market risk is the directional risk. So how do we mitigate this? We do this by trading with the trend. So this is called trend trading. So we can use a simple moving average. We can look at support and resistance lines. But if we trade with the trend, aka when the market's going up, we do bullish strategies. When the market's trending down, we use bearish strategies. When the market's staying between two levels, you use a neutral strategy. That's quite simple. Now, number 2 we have is volatility risk. Okay, so volatility risk, when you're selling options, you have a lot of volatility risk, which means if the risk in the market goes up, the options contracts then become worth more because they're insurance. Okay, and if we sold them, we only make money when the contracts decrease in value. So if they go up in value because of volatility, we're now losing money. So volatility risk is an issue. So how do we eliminate this? Well, we can help decrease it by, number 1, only trading when volatility is in our favor. So again, putting rules around VIX. So for instance, if VIX is greater than 15, then maybe we use 40% of our account to trade with. Or when VIX is, at a higher risk, because the lower VIX is, the more risk we have. So if VIX is around, $5, then maybe we only use 20% of our account. So that we're still generating money, we're still in trades and making money, but when volatility is lower, which is VIX, the volatility index symbol, when VIX is lower, we're in less trades so that we can mitigate our risk that way. Another way is, as I mentioned before, we can also extend our DTE. So doing longer DTEs also increase our safety for volatility because it's less volatile for the longer contracts because we have more time to be right. So longer DTE, and this is why we target 90 to 120 because we get rid of a lot of the volatility risk. So these are some of the biggest risks that come into the market when we are trading with options, and these are ways to overcome them. Now, what you guys have probably been wondering is, how exactly do I do this? How do I personally put all this together and make $5,000 a month, depending on the month? Of course, some months I do better, some months I do worse. I can't really make a promise that you'll have the same returns, but if we're looking at it from this perspective, it's super simple what I do. I have found that options selling is one of the greatest strategies ever. That's why I do it. It gives you really high win rates, gives you consistency, generates monthly income. And like I mentioned, I do this for over 600 other people. I help them do this, and they've made over $600,000 in profits, and it's insane. It's awesome. And so what we do is I built this tool called the Options Auto Trader that allows you to automate it. And so this is the way that you can kind of scale up and do well. And what I mean by that is, click on, again, I'll just walk you through how I do this. I just plug in all the rules for the strategy that I'm doing into this software, and then it automates it for me. So I connect my broker. And so again, I can connect really any broker I want. And once I connect it, then I just automate my strategy. So for instance, my favorite one is the strangle strategy. So I click on, I'm going to trade a strangle. And as I mentioned before, we can pick how we want to trade it. So I already told you the best levels. Again, I prefer futures options, but for this instance, we'll stay with SPY. Again, like I mentioned, days until expiration, I like further out. So I like around 90 to 120 DTE. So I'll just put 100 DTE to target. As mentioned before, on my strangles, I like doing a 10 delta put, and I like doing a 5 delta call. So that's just what I plug in here. Put delta 10, call delta 5. And so that's exactly how I structure it. Next, how often do I want to enter the trade? Well, this depends on how much money you have and how much you want to put into the trade. But ideally, just once a week is a good time to do it. If you have more money, you can do it twice a week. I'm personally doing mine on a twice a week basis. You can do that. And so we'll plug that in there. You also get access to take profit and stop loss percentages. So like I mentioned, I like to target a 25% take profit, and I don't put a stop loss on it. Instead, I exit early at 21 days. And this tends to give me a really good run rate. And so if I save and continue this, then we can see here now it's asking me how much money should this bot use. And so let's say I want to trade with no more than $10,000 for this bot. So now that's how it's being run. Now remember the safeguards, how you can change how much you're trading based on VIX to decrease the volatility risk? Well, you can do that by simply clicking enable. And now it's going to change your position sizing based on where VIX is. You can see here, if VIX is lower, they'll only use $5,000 to trade with. If VIX is higher, they'll use the whole $10,000. So now I can control that risk. Also, I can get out before the market crashes. And so again, this helps me eliminate the market risk. And so again, those are some ways that I can eliminate risk automatically through the bots. And just like that, now here I have my bot that's going to work for me. You can see all the settings, you can approve and authorize it and see it run for you. But again, if you're someone who doesn't know how to create it, I kind of built in my own bot here. So if you go here, the Bi-Weekly Rainmaker is this bot. You can see here 97% win rate in the back test, depending on what asset you're trading with. You're looking at about $100 profit and about a $1,000 loss, and you're in the trade for about 2 weeks. If you want to see the actual back test, again, we can come in here. There's back tests provided for all of our example bots. And so if I go in here to the Bi-Weekly Rainmaker, you can see it's just a very consistent, very stable asset. Again, if you want to see the specific option Omega back test here, this is what it looks like. Very stable, very consistent, and this is why the strategy prints money for myself and my members. So again, whether you're trading it manually or you're plugging it into an automated system like the Options Auto Trader, this is a great strategy to run with. But again, I showed you 3 of the best ones already. Anyways, this was 5 years of no BS options selling advice. I hope you learned something. Please smash that subscribe button if you did. And if you want to start automating your options trading, make sure to click the first link in the description down below. All right, see you guys.